Hi, good afternoon. I'm Kevin Noblet, Managing Editor for Wealth Management, a little redundant sounding, at Dow Jones. And welcome. We've got a panel that I'm honored to be moderating. I'm going to let them do the talking. We're going to keep the format informal. We'll have a conversation for about a half an hour, and then we'll invite anyone who's interested, just by Sabru tradition, to come up and speak, as long as they're a Sabru member, as long as they identify themselves. When policemen go to parties, they get asked to fix tickets. When journalists get invited to parties, they get asked to predict the stock market. If they're being honest, both will tell you they don't really know how to do it. Well, at least journalists don't know how to predict the stock market. These days, though, at parties, a lot are being told by other people just how scary the markets seem to them, how alienated they've become with markets, how the game seems rigged, how all kinds of complex, inexplicable things are happening. And anybody who just listened to the last conference, where you heard expressions like prices aren't based on anything real, I think there's a general sense in the population of just that kind of problem. We have a panel assembled here that's really in a very good position to discuss this. It'll take a little bit of a technology viewpoint, but not entirely. We have Ann Kate Smith. Ann Kate Smith, maybe you can just indicate who you are. And she's the senior editor at Kiplinger's Personal Finance. She also worked at The Street, U.S. News, World Report, and USA Today. And I won't go through her entire bio. You've got those in your programs. What I asked each of the participants to do instead was to give me a good and bad stock investment that they had made in their lives. And Anne bought shares in a tech IPO in 1999. I think it went up the first day, but then never hit the share value again. Am I right?
Correct.
Yes. All right. That was her worst purchase. Her best was she bought into a prepaid tuition plan instead of into a 529, so that when 2008 happened, she didn't lose 40% of the value of it. David Lauer is also here, sitting in the middle. He's a consultant on market structure and designer of trading technology. He worked for Alston Trading and Citadel Investment Group. He testified to Congress about what he described as a crisis in the markets and the potential for new crashes that would make the May 2010 flash crash look tame by comparison. Perhaps Dave's best investment was he bought Bitcoin at $3. I think he lost 10% yesterday, but he's still very much on the winning side of that bet.
Yeah. Oh, I got to talk to you.
We have Andy Brooks. He's Vice President and Head of U.S. Equity Trading at T. Rowe Price Mutual Fund Company. He also testified to Congress about high-frequency trading, which he described as death by 1,000 cuts to market integrity. He buys T. Rowe Price stock every couple of weeks, considers that a good move. And he bought old Maryland National Bank preferred shares for his mom, and she got a new kitchen out of that.
That's right.
Jerry Davis, Professor of Management and Sociology at the University of Michigan's Ross School of Business. He focuses on a lot of things, among them how corporate social responsibility has evolved or devolved, depending on how you're looking at it, and on whether shareholder capitalism really works. His personal investment history is pretty boring, he tells me. He's a buy and hold guy. Leans a little towards socially responsible funds, and he only checks his portfolio 4 times a year. But as boring as he is about his own investments, he's pretty exciting when he talks about the markets and the financial catastrophe we can look forward to. And Gail Marks Jarvis, syndicated personal finance writer, columnist at the Chicago Tribune. She bought ETFs in gold mining companies not too long ago, and she's down about 25% on that investment. But she got out of tech and advised her readers to get out of tech just a few days before the crash in 2000. Very smart. I don't think her husband was out, though. He was still in it.
No, so that's the worst investment. You write a column, you tell everyone to get out of tech, then you find out your husband was buying tech. You have to ask yourself if the investment in that husband was good.
Gail's also an author, and her latest book is called Saving for Retirement Without Living Like a Pauper or Winning the Lottery. And that reference to gambling is a nice place for us to start. There's nothing new about the idea of describing or thinking about the stock market as a casino, but never has have so many average citizens had a stake in that game, in that casino, as they do now. And we might even say we, are petrified by what we read in the news about the markets. Hyper-fast algorithmic trading, black boxes, dark pools, complex derivatives, insider deals, rate manipulation, hedge fund shenanigans, widespread corporate greed, and probably a dozen other topics that I just haven't listed there. David, maybe you can start us out because you've actually looked inside a black box or two. How ugly is it in there?
Well, Goldman has the best quote on this. And when they were afraid that their source code was stolen by a former employee, they said, in the wrong hands, this could be used to manipulate markets. The obvious statement being Goldman is the right hands. And I would say that many people working in the industry don't believe they're setting out to manipulate markets. They're looking at, they study the market and they look for inefficiencies. And that's been natural over the course of the market for a very long time. What you see is when you have structural inefficiencies in an extremely complex system, those inefficiencies don't get arbed away. They don't go away. And that's, I think, one of the main criticisms of high-frequency trading, and certainly the complex market that we are confronted with today, created by the regulations and the fragmentation of the market into now up to, I think, 17 exchanges, 50 dark pools. It's more than those of us who are trading in it could really understand. It's certainly more than the average person could understand. And I think the complexity and the difficulty in understanding what's happening and the relationship of prices to enterprise value, as the previous speakers were talking about, is something that people fear a lot. And they fear that the market movements are somewhat divorced from reality and inexplicable at this point.
I remember we had a speaker at the Cebu conference in New York not too long ago, Larry Leibowitz, high official at the New York Stock Exchange and brother of Jon Stewart, who was trying in a somewhat passionate way to make an argument that the little guy is protected by the system. I see you smiling about that. What was remarkable to me is he had to use a whole lot of 6-syllable words to try to explain this principle to people. And I'm thinking, if you got to use 6-syllable words to tell the little guy that his interests are looked after, then you're just not going to succeed.
I'll tell you, from the perspective of a high-frequency trader, the little guy is the juiciest of all. You do this thing called order flow classification. It gets complicated, but basically what it means is if that retail order ever makes it to market, and it usually doesn't because it's filled by internalization systems at Citadel or at Knight Capital, but if it ever makes it to market, that's the juicy flow. That's what you want because it's totally uninformed and they'll pay the spread every time. So just a little inside tidbit.
David, you also testified, I think, the same day to Congress I'm sorry, Andy, you did. But on a slightly different aspect of the markets. Maybe you could talk just a little bit about that.
Yeah, so I think everybody likes to say and likes to frame their conversation about the markets as if they are particularly interested in the little guy and the individual investor. And institutional investors like T. Rowe Price are an aggregation of millions of little guys and gals. So we represent everybody. And so David talked about the juicy order flow of the retail investor, but in some respects that's also us. as we try and mimic and disguise our order flow, often looking like retail. And so we're in the midst of this big game that's going on here, and some of the challenges to market structure. And frankly, all of you all are represented in this too, because you have 401k plans, defined benefit plans, 529 college savings plans, all kinds of things that are all sort of commingled, if you will, in the marketplace. And our sense is that we have become overly complicated, and we've lost sort of the reason that the markets were created to begin with and who they were supposed to serve. So I think David said there's 17 exchanges. I thought we were at 13, but in any case, there are a few too many in the United States, and we have 40-plus or 50-plus dark pools that really provide no transparency to investors and really very limited benefit to price discovery. And David and I probably agree on a lot of things. We might disagree on the creation of enterprise value. I think the market is efficient over time in the pricing of securities, and investors of all classes should feel comfortable about that. But there is a game going on here, and a lot of people have been incented through regulation and arbitrage opportunities that are not self-correcting, if you will, have figured out a way to interposition themselves in between true investor interest. And market makers and other intermediaries have been part of the marketplace forever, and they're good for the market when they operate appropriately. I think our sense is that there's some advantages that they are getting that are not fair, and we would love to see some experiments, some pilot programs, the SEC and others engage in some really constructive 360 sort of self-evaluation. We haven't done that for a long time. You know, all these things we've done, how are they doing? How are they performing? When was the last time you all didn't get a review from your boss? I'm guessing it happens every 6 months or once a year. I hope it does. You should get that. We need to review the marketplace. We need to examine what we're doing and how we're performing. And we've been reluctant to do that. And we don't have the answers. We don't suggest we have the answers. It's highly complex, but there's stuff going on that's undermining investor confidence. And at the end of the day, that's really what we're self-interested in, because our sole focus is to serve investors. If investors don't feel good, that's bad for our business, and we'd like to correct that.
The individuals don't feel good, but when I heard you testify, what's really interesting is how this actually affects individuals with mutual funds. So you're out there trying to decide if you should buy a stock or sell a stock. But what you described is all these other characters are purposefully sending signals,
right,
basically phony decisions to buy or sell a stock, so that when you buy my stock in your mutual fund that I'm counting on to do well, you may buy it at a higher price than you need to or sell it. And then I, the mutual fund investor, is hurt by that.
Absolutely right. So if I said to you all that, I don't know, 94, 95, 96, 97 times out of 100 that I stated publicly I wanted to buy 100 shares of General Electric, I canceled that order 95% of the time before anybody could respond to it. Would you think that that was disingenuous? Would you think that there's something wrong with that? Would you think that I was playing a game that should be sort of exposed?
That is a game, but you don't have to play it. Individual investors don't have to play that game. The best protection for the little guy is the little guy or gal herself, who starts out not looking at what the market's going to do today, or if I get GE at a tiny bit better or worse in an hour. But if I own GE for 5, 10, 20 years, I think checking your portfolio once every quarter instead of once every hour or once every week is much better. I think gaming the market is a huge concern with investors. I hear all the time that people are losing confidence. They think the game is rigged. They don't think it's a place for them, but they don't have to play the game. They start out with an investment plan. They think like a business owner or even a good shopper. You buy when stocks are inexpensive, you hold them as long as the business model pans out, and when they get expensive, you lighten up.
Right.
You do that by rebalancing your portfolio, which is, tough to discipline yourself to do. But, the little guy can protect himself.
I think Gail's point, though, and it's a critical one, and one that Andy, I think, would agree with, is that we are all invested because we do generally all own shares in mutual funds and ETFs. And as they go to market with their large institutional orders, as they rebalance or as they have to take in new interest and establish new positions, they're getting nickeled and dimed. And so execution quality and market quality is eroding long-term returns, right? So the impact as the institutional investors go to market is felt in a much greater by much greater magnitude 10 or 20 years from now, because they've had this erosion and this inferior execution quality.
I think, Ann, what you're saying is right. Really thoughtful and successful investors take a long-term view. They make the right decision about asset allocation. They figure out where they should be on the risk curve as they get older. They rebalance as things get, Great investors play excess. When things are really frothy, 2000, tech stocks are tripling. I played golf one day. I'm a terrible golfer, but I played one day with a guy, a friend of mine. He got an allocation on an IPO in 1999, and he was told he got 1,000 shares on the third hole by a guy going down the other fairway who happened to know his broker. And when we finished the turn at the ninth hole, he was told it was up 300%. And I looked at the guy and said, "You just made a lot of money. You ought to sell it right now." And he said, "Well, if I sell it right now, I won't get the next allocation." I said, "Oof." So I think he ended up making a little bit of money, but not a lot. But my point is that a lot of this is noise to a lot of people, and markets open on time, they close on time, trades settle, mostly things work. But in between 9:30 and 4 o'clock, there's a lot of gamesmanship and things going on that are not very or not things that are being done well or that are serving investors. And over time, Ann, that does detract from the performance of everybody, because we represent all those individual investors. And what we're saying is some of the activity of market makers and intermediaries is okay, but some of it today is not good. And there's been this incredible, aggressive push for speed. Speed to the market, speed to data, speed. And speed kills. Speed is reckless. And we've got to slow down a little bit and try and understand what's proper and legitimate market information and market data, and what's noise that's causing you to be distracted and that misrepresents true investing interest. And that's the part that is unsettling, I think, and that frankly has led to the flash crash, some of the stuff with the Facebook opening, some of the stuff at Knight Securities. So many people feel that the basic foundation and infrastructure under the markets has been torn away, and really the markets are not as stable as they need to be, because in this quest for speed, we've removed a lot of impediments that slow things down, and things like double checking, things like being careful, things like making sure you can do things like redundancy, which is incredibly important in markets. So,
Jerry, I want to get you in the conversation. You say you're a buy and hold guy, so you believe in that investing philosophy, but don't you keep yourself up at night sometimes when you do those studies that indicate that corporate governance seems to be on a irrevocable decline?
So I do have a bunch of concerns. When we talk about the little guy and your friend on the golf course, that friend on the golf course is not the little guy. According to the Fed's latest survey, 15% of households own stock directly, even one share. So if you see that commercial for E-Trade with the baby on his BlackBerry, I thought that was documentary footage. It turns out that is not actually what happens. Almost nobody actually buys shares directly. They buy from T. Rowe Price. They buy exchange-traded funds or mutual funds. And that number has also gone down a bunch. It had reached a high in 2007 at about 53% of households. It's now at less than 50% for the first time in 15 years. So participation in the markets is sort of broad, but not very deep. The median portfolio is only $29,000. So people are invested about one Toyota's worth in the market on average if they're invested. I think it's worth keeping that in mind. On the demand side, the people that are going to make reforms are going to be Andy and friends, the people that are the institutional investors. The individuals probably don't have a chance. If what Dave says is correct, we don't have a chance. Don't even try and game the system. You're going to invest through intermediaries and hope that you pick the right one. My concern is really on the selling side rather than the demand side, which is that the number of IPOs still hasn't turned around. We got half as many public corporations today as we did 15 years ago, and it keeps going down as the Eastman Kodaks get delisted, and then Zynga goes public, which I hope my pension is not invested in. This is not intended as investment advice, by the way. And they thought they were going to fix it with the Jobs Act. It was all because of Sarbanes-Oxley. But in the years since the Jobs Act, there have been 20% fewer IPOs than in the year before the Jobs Act. So I don't think that's the problem. I think that there's a drought of public offerings, and that's probably my biggest concern.
And I think a lot of that has to do with confidence in the stock market and understanding the stock market. And an chief executive doesn't want to go public if they don't believe that their stock price is going to reflect enterprise value, that it's going to appreciate as they take actions to improve the long-term prospects of that company. And so you have this drought in listing, you have equity market outflows from the retail side and a drop in equity ownership during a historic bull run. That has never happened before. These things have always been tightly correlated until now.
But,
if CEOs, with their supposedly sophisticated understanding of markets, don't trust the pricing capabilities of the stock market, why should I?
Yeah, I'm going to take issue with what Dave said there. I don't think CEOs of small emerging growth companies are not going public or delaying going public because they're worried about the valuation, at least the market's ability to value their companies and their enterprise. I think they're delaying it and doing different things because sometimes the process of going public is incredibly onerous, and that's the part that the Jobs Act was supposed to correct. But this takes a long time. So you can't turn on a dime on some of these things. Reporting requirements, disclosure, scrutiny. There are a lot of things. Cost. A listing is expensive. Accountancy and legal fees are expensive. There are a lot of impediments that suggest that maybe you want to wait. And then you have enormous amounts of money in private equity and other entities that are grabbing these companies before they go public. They're saying, hey, sell to me now and you'll do pretty well, and we can avoid all this other stuff that happens when you go public. Quarterly report, earnings pressures, conference calls, a lot of stuff. It's hard work. But the market valuations and balance sheets today suggests a lot of companies are buying their stock back pretty aggressively, which is shrinking this flow out there. And the individual investor who's scratching their head wondering what to do or whether they should be in, I kind of remind them that last year the market was up 17%. First quarter we were up 10% in the S&P. And if you were in money markets, by the way, you earned zero. Okay? And we do have some inflation in this country. And so I don't know where else you go. And the great mistake I think that a lot of people make is they try and be all in or all out. And that's really hard to be right 100% of the time like that. So good investors stay in. They figure out how to rebalance. When they think things are a little excessive, they pull back a little bit. But you got to stay in the game. And I worry that that we're losing a generation perhaps of people that benefit from the wonders of a solid investment program that's been disciplined and things like that. And I hope we can avoid that for these people.
I agree. There are so many things that need to be looked at and explored in the market and maybe regulated. But in the end, it's the best game in town. Stocks over the long run will beat inflation. The bonds are more risky now than they've been in 3 decades. You have to do something while you wait for people to figure out what's going on with all of these things. You still have to put your kids through school and save for retirement. And hopping in and out of the market is absolutely the only thing worse than getting slammed by a 57% bear market is not being in the market when it turns around. Because
I got to say, though, when you look at the last 15 years, and it's a critical time period, I agree, and you look at the gyrations in the market, it seems reasonable to question, are people being compensated in terms of returns by the amount of risk they're taking on? And the risk and the volatility is an unnerving thing. When you see your portfolio value change so dramatically over 5 or 10 years, I can understand why people are afraid.
You know, we used to have a wonderful fellow that was a portfolio manager and analyst who worked for us, and he had a great sense of humor, and he was a very clever guy and great investor. And he used to say, today is the hardest day to invest. Today is the hardest day to invest. And I said, what are you talking about? Well, you know, there's always things to worry about, right? So think about that. If you always got to the door and didn't step through it because you were worried about what's on the other side, you never go anywhere. So you got to take a leap of faith. You got to stay with things. This past decade has been tough for investors, but boy, if you had the stomach to step in 08, 09, you're looking pretty good. Because
Absolutely.
A lot of
You're up
stocks
like
are up a lot.
140%.
Yeah.
But yet, I mean, I keep a file, an email file, that I call anger and frustration. And I had to start a new one because I was ruining my computer because I was getting so stuck. Thousands of people have written to me over the years. And the lack of trust is like something I've never seen before. And to some degree, it goes back to the last panel. So people realize that in 2007, Bernanke said the subprime situation was under control. It wasn't going to blow up. Then we find out it does blow up. Then we find out that Paulson and Bernanke have to run to Congress and get $800 billion immediately, or the world as we know it is going to blow up. Then we find out that they're printing money like crazy, and people say, is this a real economy? Are the profits we're seeing real? Are they jacked up on some kind of steroids? Do I understand this? Then the flash crash comes along. Overnight.
But you skipped Bernie Madoff, too.
Yeah, Bernie Madoff, for sure. You know, one of the biggest questions I've had in the last few years is, can I trust my advisor, and how do I know? And then you had Facebook. And Facebook was supposed to be the IPO that was going to make people believe again. And instead, it turned into a disaster. It told the little guy who loved Facebook and said, I'm going to buy that stock. It told them that they could pay $42 for a stock that probably should have come out at 28 or lower. And you take a bath one more time. First, you take a bath on the financial crisis. You get scared by the flash crash. Then you take a bath on Facebook. And the little guy says, is this really for me? And your point is good. The little guy could be a buy and hold person in mutual funds, but they don't feel safe there either. And I'll tell you one about the mutual funds. The industry's answer to the little person with a 401k has been dump them all in target date funds, babysit them, don't make them understand the stock market, tell them they'll be okay if they just do that. But that didn't work either, because in 2008, when the stock market was plunging, my phone rang incessantly from people in target date funds who were saying to me, my employer said this fund would get me ready for retirement, and I've lost everything. Well, they didn't lose everything,
right,
but they felt like they had lost everything. And behavioral finance tells us that when you face a loss, it's the scariest thing, and you will give up on a chance for a gain if you're too afraid that you'll have a loss.
Yeah.
Well, I think that's a big problem, especially with young people who have only heard of Bernie Madoff or the flash crash or what have you. They're just not interested in stocks, and it's talk about being out of the market at the wrong time. If the greatest contributor to asset building is the miracle of compounding, and if these young people don't get in the market while they're still young, they're going to give that up. But
so I have a colleague who's 40, and he said, I graduated, I entered the workforce in 1999. All the personal finance columnists told me, put all of your money into a diversified mutual fund, buy and hold. So the S&P 500 was at 1469 on the first day of 2000. It's about 1,500 now. If he'd put that money into a credit union, he'd have much less sleepless nights and a lot more cash.
But again, there's no free return, right? There's no riskless excess return, and that's something that you learn in economics and in finance. If you're going to earn return above and beyond the rate of interest rates or inflation, you're going to take on risk. So the idea that you can put all of your money in the stock market and over the long run you'll be better off, there's risk associated with that, and that's what we're seeing. And we're seeing volatility and risk, and that's why people are scared.
But all assets are risky. Cash is risky.
We'll go to
because
questions
it's
very
eroded
quickly.
by inflation.
I just want to make one point on that, though, that I think part of what we're talking about here is that everybody's not facing the same risk. That a lot of people are alienated because they have the sense that certain players have reduced their risks by passing that off to other players. And from everything that I've read, it's not a totally inaccurate perception.
Well, I think all of us need to know that the police are on the beat, that the regulators are looking at things, and that people understand that insider trading is illegal and people go to jail, and that when people do things that they shouldn't do, they get caught. And I think we can always redouble efforts there, but there have always been people that are bad actors in our industry and every industry. But the vast majority of people are trying to do the right thing, and I think you gotta know that, and you have to know that when you read a budget item that says they're gonna cut the SEC staff or something like that, you're saying, why would you do that? We're all dependent on the markets working well and there being proper surveillance. But I think it's important for all of us to know that the business is very cyclical, and we've gone through a decade where we've had 2 huge bear markets, and you've never really seen that before. And this is a very unusual 10-year period. Pick any other 10-year period, things look a lot better. Start your 10-year period in 2008 going forward, and the numbers look pretty good. We're not through the 10 years yet. But keep in mind sort of where you are, where you entered, and where you need to exit. That's the real challenge. If you had to exit in 2008 and sell everything, your timing was unfortunate for sure.
But you shouldn't have been in the stock market if you needed the money in 2008. That's the whole thing. You have to start with your plan.
Right.
It depends on your circumstances, depends on your risk tolerance, depends on your age, depends on when you need the money. And stocks are definitely a long-term investment. 3 years or probably longer. You don't have money in the stock market for college if your kid's a high school junior. That's for sure.
I think one of the things that Andy said is critical, and that is the regulation side and the enforcement side. And I think it's hard to pin the fear of the market and the future of the market to individual causes, but one of the major ones is the belief that the SEC is not keeping up with technology, with high-frequency traders, with market manipulation. As Andy said, there have always been bad actors, but at this point, our regulators are increasingly unable to find them because of technology systems that are outdated or because they don't have the tools. And so, as I have spoken about on countless occasions, from here to what's called the consolidated audit trail, we're still in a complete blind spot. And I think if the regulators took an intermediary step and got on top of things with some relatively simple technology, you would see at least some more confidence return, knowing that the bad actors are being found. Because if they had just a little bit of insight from a technological perspective, the things they would find would be egregious, obvious, and easily punished under existing laws.
And when you testified at that hearing in September, I think Senator Reid promised very quick action because he said, we just couldn't afford to let this go. But I don't think anything's happened since then.
It's the wheels of Congress, the wheels of progress move very slowly, and it's been frustrating. And I guess, what we're trying to do is, and the reason perhaps all of us agreed to speak today, is to encourage you all, as you can do so well, inform your readers to ask questions about some of these subjects and to challenge assumptions and sort of the status quo. I think the press did a pretty good job of identifying the excessive expectations that existed in the tech stocks in the bubble of 2000, 2001. I think you all did a very good job of telling all investors that the Facebook IPO was pretty heated up and perhaps unsustainable, the enthusiasm. And there were a lot of columns written that said, why don't you look at it in 2 weeks after it goes public? Don't play on day 1, play on day 15. So we think it's a good time for you all to be suggesting to your readers to talk to their congressmen and women and say, what's going on with this marketplace? How come there are these excessive cancellation rates or all this stuff going on? It looks like it's gamesmanship that's not productive and scares me.
And the time to do that is now. It's not in response to the next crisis.
Boy, you bet.
Seems like there's an irony here that the reason why we're not getting more IPOs is too much regulation and it's too costly, and yet the fix for getting more people into the markets is more regulation. I'm wondering, how do we balance?
Different regulation, and we're talking about regulation of behavior, not regulation regarding filings and the extent of reporting that needs to be done and other things that are expensive for small companies.
And enforcement is different from regulation.
Right.
It's enforcement that's needed, and they cannot enforce what they can't find, and they can't find these things right now because the technology systems aren't capable of it for the regulators.
I do want to leave a little time for questions, if anyone has them. Step up to the microphone. We could, I don't make it a little, since they got to confess their own worst investment. You don't have to, but it could be a little bit like an AA meeting if you want.
Pets.com.
You can ask your question, and if you can very concisely describe some blunder.
My name is Brad Allen. I did not buy Facebook. I guess that's all.
Well done.
I'm a freelancer. I write for Investor Relations Magazine, Corporate Secretary Magazine, amongst other publications. And I'd like to ask a question about the technology and high-frequency trading from the issuer standpoint. When I was taking Finance 101, I learned that the cost of capital is impacted in part by volatility. And I got to believe that high-frequency trading lives off of volatility.
Yep.
I talk to high-frequency traders, and they say, oh, no, we provide liquidity. Have you seen any research, number one, or number two? Would you comment on whether or not you think high-frequency trading increases issuers' cost of capital? What is the impact on cost of capital?
High-frequency trading is a cost in the market. It's a friction in the market. So I would say, yes, it does increase the cost of capital. It's sort of a straw man when you want to compare it to a decade ago or the specialist system. I think that's a ridiculous comparison. I think you should compare it to what it could be, what an advanced technological system that is powering fluid markets could look like versus what it does look like, which is extremely fragmented, complex, difficult to navigate. And for high-frequency trading, they thrive off of two things, in fact, volatility and fragmentation and complexity, because it is their business. It was my business to study market structure, understand where the inefficiencies are, and to exploit those. There are studies, all of them industry funded, that show volatility has dropped. And when you start to look at the numbers, they don't really add up, they don't really make sense, or there are different ways of looking at volatility. It's an unfortunately nuanced argument. There are some more studies coming out very soon by RBC that should demonstrate that there are different ways of looking at volatility, perhaps more accurate ways that show that volatility has increased in certain places at certain times when it really matters. And that's when HFT sort of thrives and makes the most money.
General Electric probably has an average spread intraday between its high and low of, 1.5%, 30-some cents, I'm guessing. And their business doesn't change that much every day. I don't think their stock price should either. The other thing I might suggest is Dave and I were talking about this the other day, but the issuing side of the equation in the conversation has been woefully quiet. If I were Accenture or Procter & Gamble or any of the stocks that were hit during the flash crash, I'd like to know why someone kept routing orders to markets that were less and less liquid and that were not generally displayed and places where there was no sort of semblance of best execution. Accenture went from $42 down to a penny. Who routed the stock from $5 to $4.50? Why did they do that? What marketplace was that? What's that about? How does that happen? And someone who took an order from an investor, or maybe it was a prop trader or whoever it was, that took an order when the stock was at 39 to have routed it to a market that was bidding 5. Are you kidding? I mean, go to jail right now. Who made that routing decision? So there's this whole subculture about where orders go and how they're prioritized in different places that is really not generally in the interest of the investing public. And that we need to talk about that. We need to ask ourselves, are we doing the right thing for investors? For everybody, by the way, not only T. Rowe Price, but the individual and the issuer or the sovereign wealth fund or whoever it is. Everybody's sort of party to this problem.
People need to go to jail.
Well, that would be
And your point also was this argument that these traders create liquidity. You say that in the flash crashes, and you say there's many of them all the time, just littler ones, that the traders disappear. They're not coming in and providing liquidity.
Yeah, absolutely. So I can tell you, one of the core beliefs officially for the official account of the flash crash is that it was not caused by HFT. And I was on a trading floor, in fact, the largest equity futures trading floor out there on the day of the flash crash. The flash crash started in the futures market. And we had the exact same reaction as every HFT shop did on Wall Street. And if you consider at that point that HFT was providing anywhere between 60 and 70% of all market liquidity, and you watch the market drop from down 3% to down 5% in a couple of minutes, and you say, what just happened? Click. It's that simple. You hit a button, you're out of the market. All of your orders get taken out of the market. And as we took our orders out of the market, so did every other liquidity provider out there. And the market, when you were watching it on the screen, it disappeared. There was a moment where there was no order interest in the market. And so to say that HFT didn't cause the flash crash is a very semantic argument that is mostly made, I think, by people who were not on a trading floor that day.
Let's move to the next question.
The folks at GetCo must love you. If we're making confessions, I worked for McGraw-Hill for about 22 years, and I own entirely too much of that stock. McGraw-Hill owns S&P. My question, though, is David Stockman had a rather dire piece in the New York Times recently, in which he warned about the disconnect between the market and the economy, and he suggested that we're in for another big crash, I think. Is he right?
I listened to him a little bit in the back. I didn't hear the whole thing, but at one point he was telling people to get liquid and to pay off debt and be prepared. And I thought to myself, wow, my first mortgage, owner financed 14%. The bank was at 18%. Okay? Today, we have people that are working on my team buying houses and paying 3 1/4, 2 3/4 for a 30-year mortgage or 15 or whatever it is. And I thought to myself, this is a spectacular time to borrow money appropriately, reasonably, risk-adjusted, sort of carefully, but to spend, to invest, to hire, to grow. So, I'm a glasses half full guy. This is a great country. We got a lot of problems, but we will solve them. We might not solve them quickly. We might not solve them the way you want to solve them. We can differ on things, but we generally get there. So I think Stockman, I'm out on that. I'm not buying his book. Sorry. Not a believer.
It sounds a little alarmist to me too. When you look at the micro view, people get scared when they look at the huge macro view. But you look at a company's earnings. The quality of earnings is very high. Corporate profits are very strong. There's a lot of cash in those profits. It doesn't seem like a doomsday. It seems like we've gone pretty far, pretty fast, maybe a little correction, but I can't imagine it. I don't see the disconnect there.
I'm not a doomsdayer, but I will say that the majority of trading these days is based on correlations. And so we our mathematical models serve to reinforce those correlations and to increase them. So the 2008 crisis we would refer to as a correlation equal one event. Everything was correlated. So I fear that we are heading in that same direction. I don't know that a crash is imminent, but I think that the idea that a black swan could be around the corner and it can be inexplicable, it can be not tied to enterprise value or an erosion in earnings, but it can be a glitch or a reinforcing event, a positive feedback loop like the flash crash was, is certainly possible, as very little has changed since then. And if the flash crash were to have happened, let's say, an hour later in the day, and the market closed before it could have bounced back, that could have been a disaster. That's why I fear the next crisis, and I'd like to see action before the next crisis.
But it wasn't a disaster. If you were a long-term investor and if you were out for the day, the flash crash wasn't a non-event for you. And
luckily, because it was at 240, not 340.
What people think was a disaster for them was 2008 and 2009, because we were a culture that believed in the stock market, especially the baby boomers. 1 in 4 had 90% of their 401k invested in stocks. Those people got slaughtered. And those people got out at the worst time, did not get in. If you look at what's been happening with flows, people have pulled about $400 billion out of the stock market since 2008. They put just a trickle back in, and they put almost $1 trillion into bonds. And my fear is they could be set up now, because they think stocks are the bad guys. They could be set up for bonds, and bonds can lose money too, with just a couple of percent changes. You could see big losses in bond funds. People have to know that. They have to know that there are risks there. They also need to know, and I went back and tested this, after all the people called me and said I lost everything in 2008, 2009, I went back and tested the advice people are given to have diversified portfolios. So I created really simple portfolios, just like half the S&P 500, half long-term bonds. And if you would have, in 2007, when you thought everything was great, you would have just divided $10,000 that way, half and half, you would have gone down to about $7,100. And that's when you would have been on the phone to Gail Marks Jarvis saying, I've lost everything, what do I do? But if you stayed the course, in less than 2 years, you had all your money back. And in 3 years, you had about $13,000. I think people need to know that, because they still think they lost everything. And they need the illustration, which is why I went back and put it in my book. I had a first edition come out in 2007, and so many people were calling me and saying, do you really believe it? Do you really believe it? Do you really believe it? That I did test it. And the new edition shows people exactly what they would have lost in each portfolio and how long it would have taken to get back. And for those of you that write on personal finance, I think you need to tell people in dollars and cents what really happened to build up their confidence again.
We're going to have time for one more question, and it'll be from the incoming president of Sabo, I think.
Kevin Hall. I have Kevin Noblette manage all my money, so I have to ask him.
Oh, yeah, there's a good idea.
You know, like Gail suggested, I went heavily and went all in 2008 because it was pretty clear regulators weren't going to let it crash and it would be coming back. So I think people cashed out, unfortunately. Question is about demography. One of the premises is that the baby boomers, 75 million of them exit into retirement, and they disproportionately hold 401k plans and hold a bigger share of that wealth. The assumption has been they'll sell it off to someone else, and at least under the Bush administration, the assumption was that the Chinese, the Brazilians, were going to have a much more global securities market. And I'm wondering if that assumption has changed, and whether you guys think demographics change the equation of the long-term outlook on stocks. And then if anybody wants to comment also about the cheetahs, which are high-frequency trading in commodities. I know that's got less attention than stocks, but the cheetahs are, I think you might be able to answer that one.
So I have concerns. I think the 401k has been a disaster for everyone involved. If you look at what people's typical portfolios are, they're pretty tiny. There's a handful of people who actually have enough saved for retirement. But the median portfolio in the U.S. is $29,000 of the half the population that has stock. You can't retire for 6 months on that, at least if you're living in a major city. So I'm not worried that the liquidation of 401ks is going to lead to a market crash or we need to be finding other buyers for that. I think the retirement system is just broke the way that it is now. We have to declare the 401k a failure and find an alternative. So.
I think that's the next crisis for the country, a retirement crisis of grand proportion, because half of people who are within 10 years of retiring have $100,000 or less. Part of that's that they haven't saved enough, but part of that is that they have invested so poorly. Financial Engines did some research that showed that only 1/3 of people with 401ks are investing fairly close to where they should be in diversified portfolios. That's a disaster, and as we deal with Social Security and Medicare, that's a disaster for the country.
I think the industry has tried, and obviously we have a lot more work to do to really push education to investors about how to invest successfully. And it is a tough job, and it's hard, and you know it from your own personal stuff. It's hard to be a buyer sometimes. It's hard to sell and things, and we got a lot of work to do there. But the importance of savings and starting early and staying with it and all that kind of stuff. If you don't know that, I don't know where you've been. And everywhere I turn, I see that. And so I guess maybe the target date funds are a good alternative for a lot of people because they're not going to be able to make a good asset allocation. And I'm sorry that the average account balance is $29,000. It better be a hell of a lot higher for people that are 65. By the way, Social Security was never intended for any of us, and we ought to decline it. Okay? It's not for us. It wasn't intended for us. Your corporate plan was supposed to take care of you. And as we've migrated in this country from defined benefit to defined contribution, we better figure out how to do it well or get better this next cycle, because that's key, right? And that is a crisis waiting to happen, because who's going to help all those people that don't have enough for retirement?
Well, on that bright note, we'll see if this conference moves from the doom and gloom that seems to have prevailed so far to maybe a brighter picture or two later in the day or tomorrow or something like that. I did want to have us thank the panelists for being here and sharing their intelligence with us. Thank you. The next session will be back on program. It will be in 2 minutes.
Yeah, I remember too. You started as a third. You worked as a star journalist.
We are bringing you live coverage of the Society of American Business Editors and Writers Conference. When they continue in about 2 minutes, this is what we heard, AOL CEO Tim Armstrong. He is one of today's keynote speakers. Coming up at around 4 o'clock, there'll be a panel discussion on the impact of social media on media coverage. And then at 5 p.m. Eastern, Federal Reserve Vice Chair, Janet Yellen. She is the featured speaker of the conference. Again, they are expected to resume in just a couple of minutes, and we'll have live coverage here on C-SPAN.
We're going to be starting momentarily. Tim Armstrong is here.
We've been trying to regulate the heat in this room a little bit. It's a little better now. It's because of the lights that's making it so hot in here, so but we're on it.
Again, the next panel in the Society of American Business Editors and Writers Conference will happen in just a couple of minutes. I'm going to get you caught up on some of our other